Price only moves because of two different reasons. A, price is balanced. When we're talking about a balanced market, we're talking about market participants that are agreeing on a price. There's an equilibrium between buyers and sellers, and this creates massive liquidity, which is considered sideways and choppy or consolidation action. So, if a market is balanced, you have buyers agreeing on a price and you have sellers agreeing on a price. Hence, price is basically stagnant. It's trading sideways in a very tight range because you have an agreement. Now, a lot of traders think sideways or choppy consolidation action is bad, and that is not the case at all. I look for balanced areas on a chart because usually balanced areas followed by an imbalance cause demand or supply zones to form. And that brings me into point number 2 of what an imbalance is. An imbalance is when market participants do not agree on price. So because they don't agree on price, either demand is going to exceed supply or supply exceeds demand. Hence, price will either go up or down. So what causes price to move up or down is an imbalance, an illiquid area of where the sellers were in control or where the buyers were in control, and that places all the orders that are going to facilitate on one side of the trade. The market moves up, then you have demand exceeded supply, and if that's followed, or if that is after a balanced period, then you're going to have unfilled orders sitting at that origin location where buy orders are going to exceed the sell orders. Same thing for supply. If market is balanced, followed by a nice drop to the downside, creating an illiquid area since all the orders were in favor of the sellers or the supply side, then once price reaches that balanced area where the market created that imbalance, you're going to have unfilled sell orders sitting at that origin location that did not get filled the first time since price basically fell too fast, and that is where that supply imbalance then occurred and was created. So this right here on Tesla, this green box, is illustrating an example of what a balanced market looks like. Like I said, a balanced market is an agreement between buyers and sellers, hence choppy consolidation sideways action. Now that is not always a bad sign. Also, we wait then for price to become balanced, followed by a demand move to the upside or a supply move to the downside, which then will validate and confirm that the balanced area will then leave unfilled buy or sell orders sitting at that rectangular box, waiting for price then to re-enter that area for those orders to be filled by institutional traders, or the big money, the smart money. Institutional traders trade with such large size that their orders will influence the market. So we have to trade with them and wait for price to then hit their orders again, and then we trade inside of that imbalance. Everything else when the market is balanced is just noise. We then simply wait for confirmation, and then we hop in once price reaches our imbalance box, and we take the trade based off of that. Perfect example is that Tesla dropped into this area, and you could have taken Tesla long out of this demand zone. Now this is not an indicator. I manually draw each and every one of these levels. I put price levels on them to label them because on different time frames you are going to be able to see different demand or supply imbalances. Now you want to be able to spot areas on the chart where the market is balanced, sideways action, followed by a nice move to the up or downside. Now this is a 30-minute chart, and like I said, on different time frames you're going to be able to see different balanced areas. We have a small body and a small candle here in this 30-minute time frame, followed by a nice move to the downside. This then qualifies as a supply zone because we had a balanced market followed by a drop, which then validates and confirms our point that at the basing candle, we had unfilled sell orders that did not get filled from this immediate drop from this big red candle to the downside. So then you fast forward into an intraday chart of when you're looking to trade these stocks or even the futures, and you wait for price to then re-enter the zone, and then you take it short because we're talking about supply, because of the fact that these institutional sell orders will be getting filled once price reaches this box. So here's an example on the S&P 500, and this is why it's important to flip through different time frames because they're each going to tell you different stories. The candles are going to look different on each time frame, and you're going to be able to spot different imbalances followed by balanced periods by looking at each time frame. Now right here I could see that price rallied. Then we kind of stalled out. Now we wait for then price, since we stalled out, we wait for a direction after a basing period, and in this case, we made a move to the upside. So this basing period right here, from this red candle, qualifies as a demand zone because we based out, the orders were then balanced. Then the next candle, we had a massive rally to the upside, which then validates that all the orders were to the buy side, leaving this balanced period to have buy orders that did not get filled, waiting to be filled once price then pulls back into this area. And as you guys can see, price then pulled back very slowly. We were trading sideways, consolidating, but we hit this demand zone. This was from 3108 all the way to 3106. So this was a 2-point risk, and we got 20 points to the upside because of that. So that is a 10-to-1 risk to reward ratio. We were risking 2 points to make 20. That is 10-to-1.